Banks proceed. Say it plainly because nobody on Capitol Hill is going to say it for you. The Senate did not vote on the Clarity Act before its August recess. That headline landed like a defeat. It wasn't one. Here's the part they aren't telling you. The banks this bill was supposed to regulate already stopped waiting on it months ago. While the cloture motion sits on a calendar, Tier 1 liquidity providers are opening custody desks, pulling federal charters, and settling tokenized trades through clearing infrastructure that already exists. Banks proceed. The vote didn't. Those are two separate stories, and this channel is going to keep them separate for you. In plain terms, the Clarity Act got delayed, not defeated, and the institutions it was written for are already operating without it. Let's start with what actually happened in the Senate, because delayed is doing a lot of work in that sentence. Think of Cloture as the permission slip the Senate needs before it can even schedule a final vote. Without it, a bill sits frozen no matter how much support it has. That permission slip is called Cloture, and the Senate filed it on August 8th. That single filing is the difference between a bill that's dead for the year and one that's just slow. Here's the part most coverage skipped. The next real date is September 15th. That's the earliest a first procedural vote can happen once the Senate returns. Put simply, nothing about this timeline says the bill failed. It says Washington is running behind schedule, which is not the same headline at all. Now, here's where it gets interesting. Some of the same banking lobby pressure that helped slow Clarity down already lost the fight it actually cared about. Last year, a separate law called the Genius Act was signed. It decides how stablecoins are reserved, redeemed, and regulated. Banks wanted Clarity to restrict stablecoin rewards so they couldn't compete with bank deposits. That provision didn't survive, which means Genius is already governing that exact competition, live today, with no second bill required. In plain terms, the banking lobby's own strategy backfired, and the law they didn't want is already running the table. Here's what that actually means for you if you're tracking this as an XRP holder instead of a policy analyst. Federal regulators have been granting bank charters to digital asset firms at a pace most retail coverage hasn't caught up to. The Federal Reserve has been building tailored payment rail access for these newly chartered firms, access that used to require routing every transaction through a traditional bank as a middleman. Strip away the institutional language, and here's what's actually happening. Banks are getting direct plumbing connections into the federal payment system, one charter at a time, without a single vote on Clarity. That's not a guess. That's how the charter approvals are coded into the regulatory filings. So how does a bank actually deliver crypto custody without spending 18 months and 9 figures building it from scratch? Think of it the way a bank never built its own card payment network. It just plugged into Visa's rails and paid for access. That's the model behind crypto as a service, or CaaS. A bank rents the wallet infrastructure, the custody layer, and the compliance tooling from a specialized provider, then puts its own name on the product. Instead of a multi-year build, it's a matter of weeks. Instead of owning every layer of compliance risk from the ground up, that risk is already engineered into the provider's system. In plain terms, a bank doesn't need a federal market structure law to offer crypto custody. It needs a vendor contract and a compliance sign-off. Look at the numbers on adoption speed, because this is where CaaS actually separates itself from the old build-it-yourself model. Providers running this infrastructure report cutting deployment timelines from 12 to 18 months down to a matter of weeks, with cost savings that regularly run above 80% compared to custom-built systems. That's not marketing language. That's the calculation a bank's own risk committee runs before approving any new product line. Here's what that actually means for you. Every regional bank that quietly rolls out a crypto wallet feature inside its existing app didn't build a blockchain team to do it. It signed a vendor agreement. Custody, trading, staking, and compliance monitoring all arrive prepackaged through a single API connection, which is exactly why this model spread through fintechs and neobanks first, before larger institutions started adopting the same approach. Think of the DTCC as the central back office engine that finalizes almost every major US securities trade. The DTCC is exactly that. And it's the same settlement rail behind the tokenized trade story we broke down featuring BlackRock and Ripple Prime. That trade moved through infrastructure that already exists, while Congress debates a law that would only formalize what's already running. Here's the part that's going to matter more over the next 6 months than anything happening in the Senate chamber. In the next section, I'm going to show you exactly which countries are already operating the regulatory framework the United States is still arguing about and where liquidity is actually moving while that argument continues. Japan's national diet passed amendments in July reclassifying digital assets as financial instruments instead of simple payment tools, paired with tax reform cutting crypto gains rates from as high as 55% down to a flat 20.3%. The UAE's federal securities regulator finalized its framework, bringing tokenized securities and commodities formally under existing law, with trading restricted to licensed venues only. Singapore and the UAE were already first movers on this. Europe's MiCA framework is fully live. Hong Kong has licensed stablecoin issuers operating today, not proposed, not pending operating. Here's what that actually means for you. While the US argues over a procedural motion, 4 major economies are running the exact regulatory model Clarity is trying to build. Now let's bring this back to the balance sheet reality, because that's the part regulators actually enforce whether or not Clarity passes. Think of Basel III as the rule book that decides how much safety reserve a bank must hold against every asset it touches. The riskier the classification, the more reserve capital gets locked up. Under Basel's current treatment of unclassified digital assets, banks must hold as much as $12.50 in reserve for every single dollar of exposure. That's not a Clarity Act problem. That's a capital rulebook that exists independent of whatever the Senate decides in September. In plain terms, the real ceiling on institutional crypto adoption was never a missing law. It's a reserve requirement banks are already working around through charters, Genius, and CaaS instead of waiting for it to change. Now, here's where this shows up in the actual chart, not just the policy calendar. A large share of institutional XRP buying never touches the public order book at all. Picture a large buyer calling several liquidity desks privately, getting a quote, and settling the trade before it ever appears on a public exchange. That's an over-the-counter, or OTC, transaction, and it's the default method institutions use for size. Some analysts have claimed the private reserves available through these OTC desks and dark pools have been shrinking fast, with estimates as low as 1 to 2 billion XRP still accessible off the public exchanges. I want to be straight with you on that number. It comes from analyst estimates, not confirmed exchange data. Treat it as a signal, not a certainty. There's a second signal worth watching alongside it. Multiple market participants have reported OTC trade settlement taking longer than usual to complete. Put simply, when private trades start taking longer to clear, it often means the desks on the other side are having a harder time sourcing enough supply to fill the order without moving the public price. That's not proof of a shortage by itself, but it's the kind of operational friction that tends to show up before a liquidity story becomes a price story, not after. Here's what we can verify. Exchange reserves fell from roughly 4 billion XRP at the start of last year to under 2 billion by December, the lowest level since 2018. Look at the numbers again, though, because the honest version of this story isn't as clean as the hype version. Low exchange reserves alone have not historically forced velocity expansion. In 2018 and again in 2022, reserves dropped and price did not follow. What thinning reserves actually change is sensitivity. A thinner order book reacts harder in either direction to whatever demand shows up next. That's not a guaranteed supply shock. That's a setup for one. So here's the actual takeaway. Stripped of all the noise, the Clarity Act is delayed to September 15th, not dead. Banks aren't waiting on it because Genius already governs the part they fought over, and CaaS gives them the infrastructure to move today. 4 major economies already run the regulatory model Washington is still debating, and the market underneath all of it is thinner and more reactive than it's been in years. In plain terms, the institutions this channel has been tracking since day one were never going to wait for permission. They found the workaround, and now you know exactly what it looks like. That's the DTCC video, right there if you want to see this mechanism already live.